Section 3.1 to 3.3 Understanding Short Selling Strategies. 3.1 Fundamental Analysis in short selling. Identifying overvalued stocks and weak companies requires a combination of fundamental analysis, financial analysis, and qualitative assessment. Here are some key factors to consider when evaluating the valuation and financial strength of a company. Financial ratios and metrics. Analyzing financial ratios and metrics can provide insights into a company's financial health and valuation. Some commonly used ratios include price-to-earnings (P/E) ratio. It compares the stock's price to its earnings per share and helps assess whether a stock is overvalued relative to its earnings potential. Price-to-sales (PS) ratio. It measures the stock's price relative to its revenue and can be useful for comparing companies within the same industry. Price-to-book (PB) ratio. It compares the stock's price to its book value per share and can indicate whether the stock is trading at a premium or discount to its net asset value. Debt-to-equity ratio. It reflects the company's level of debt relative to its equity and indicates its financial leverage and potential risk. Return on equity (ROE). It measures the company's profitability relative to shareholders' equity and indicates its ability to generate returns for investors. Earnings growth and profitability. Assessing a company's historical and projected earnings growth is essential. Look for companies with consistent or improving earnings growth rates over time. Evaluate the company's profitability margins, such as gross profit margin and net profit margin, to gauge its ability to generate profits. Competitive position and industry analysis. Assess the company's competitive position within its industry. Consider factors such as market share, competitive advantages, barriers to entry, and potential disruptors. An industry analysis helps identify the company's growth prospects, competitive pressures, and overall industry attractiveness. Balance sheet strength. Evaluate the company's balance sheet to assess its financial stability and solvency. Look for indicators such as cash reserves, debt levels, and liquidity ratios. A strong balance sheet with low debt and ample cash reserves indicates a more resilient company. Management quality and corporate governance. Assess the quality and track record of the company's management team. Look for transparent and shareholder-friendly corporate governance practices. Evaluate the company's strategic decision-making, execution capabilities, and alignment of interests with shareholders. Industry and macro trends. Consider the broader industry and macroeconomic factors that can impact the company's performance. Assess the company's sensitivity to changes in the economic environment, technological advancements, regulatory changes, and other relevant trends. Qualitative factors. Besides financial analysis, consider qualitative factors such as brand reputation, customer satisfaction, product differentiation, and innovation capabilities. Evaluate the company's competitive moat and its ability to adapt to evolving market conditions. It's important to note that assessing the valuation and financial strength of a company requires a comprehensive and multifaceted approach. It is recommended to conduct thorough research, review financial statements, read company reports and news, and consider expert opinions to make well-informed investment decisions. It's also worth considering that market dynamics can change rapidly, and new information can significantly impact a company's valuation and financial outlook. Therefore, regular monitoring of investments and staying updated on relevant news and developments is crucial. Consulting with a financial advisor or investment professional can provide further guidance and insight specific to individual investment goals and risk tolerance. Analyzing financial statements and market trends is an important part of investment research and decision-making. Here are some key steps and considerations when conducting such analysis. Financial statements analysis. Income statement. Evaluate the company's revenue, expenses, and profitability over a specific period. Look for trends in revenue growth, cost management, and operating margins. Balance sheet. Assess the company's assets, liabilities, and shareholders' equity. Analyze liquidity ratios, such as current ratio and quick ratio, to evaluate the company's ability to meet short-term obligations. Examine leverage ratios, such as debt-to-equity ratio, to assess the company's capital structure and financial risk. Cash flow statement. Analyze the company's cash inflows and outflows from operating activities, investing activities, and financing activities. Assess the company's cash flow generation, capital expenditures, and financing activities to understand its ability to fund operations and future growth. Financial ratios. Calculate and analyze various financial ratios, such as profitability ratios, example, return on equity, return on assets, efficiency ratios, example, asset turnover, inventory turnover, and liquidity ratios, example, current ratio, quick ratio. These ratios provide insights into the company's financial performance, efficiency, and liquidity. Trend analysis. Compare financial statement data over multiple periods to identify trends and patterns. Look for consistent growth or decline in key financial metrics. Analyze the direction and magnitude of changes to assess the company's historical performance and potential future prospects. Comparative analysis. Compare the company's financial performance to its industry peers and competitors. Benchmarking against industry standards helps assess the company's relative strengths and weaknesses. Consider factors such as revenue growth, profitability, efficiency ratios, and market share. Market trends and industry analysis. Macro trends. Evaluate broader macroeconomic trends that can impact the company and its industry. Consider factors such as GDP growth, interest rates, inflation, and regulatory changes. Analyze how these trends may affect the company's operations, demand for its products/services, and overall industry dynamics. Industry analysis. Assess the company's industry outlook, competitive landscape, and market dynamics. Evaluate factors such as market size, growth rate, barriers to entry, competitive advantages, and potential disruptors. Industry analysis helps identify opportunities and risks that may impact the company's future performance. Management commentary and news. Read management commentary in financial reports, earnings calls, and analyst presentations. Management's insights into the company's strategy, challenges, and opportunities can provide valuable information. Stay updated on relevant news, market developments, and regulatory changes that may affect the company and its industry. Qualitative factors. Consider qualitative factors alongside financial analysis. Evaluate the company's brand reputation, customer satisfaction, innovation capabilities, and corporate governance practices. Assess the company's ability to adapt to changing market conditions, industry disruptions, and technological advancements. It's important to note that financial statement analysis and market trend analysis should be considered together to develop a comprehensive view of a company's financial health and industry position. It's recommended to conduct thorough research, leverage financial databases, read company reports and news, and consider expert opinions to make well-informed investment decisions. If you are not confident in conducting these analyses yourself, consulting with a financial advisor or investment professional can provide additional guidance and expertise tailored to your investment goals and risk tolerance. Evaluating industry factors and the competitive landscape is crucial when analyzing a company or considering investments within a specific sector. Understanding the dynamics of the industry and the competitive environment helps identify opportunities, assess risks, and make informed investment decisions. Here are some key considerations when evaluating industry factors and the competitive landscape. Market size and growth potential. Assess the current market size and the potential for future growth in the industry. Evaluate factors such as population demographics, technological advancements, regulatory changes, and emerging markets. A large and growing market indicates opportunities for companies operating within the industry. Industry structure and concentration. Analyze the structure of the industry to understand the level of competition and concentration. Consider the number and size of competitors, market shares, and barriers to entry. Highly concentrated industries with a few dominant players may pose challenges for new entrants or smaller companies. Competitive advantage and positioning. Identify companies within the industry that possess competitive advantages. These advantages may include strong brand recognition, proprietary technology or intellectual property, economies of scale, distribution networks, or customer loyalty. Assess the competitive positioning of different companies to determine their ability to gain market share and sustain profitability. Regulatory environment. Evaluate the regulatory landscape and its impact on the industry. Regulations can affect pricing, market entry, product development, and overall industry dynamics. Stay updated on changes in regulations, compliance requirements, and potential legal risks that may affect the industry and its participants. Technological disruption. Consider the impact of technology on the industry. Evaluate the potential for technological advancements, innovation, and disruptive business models. Industries that are susceptible to rapid technological changes may experience shifts in market dynamics and the competitive landscape. Supplier and customer power. Assess the bargaining power of suppliers and customers within the industry. Evaluate the availability of alternative suppliers, switching costs, and the concentration of customers. Understanding the dynamics between suppliers, customers, and industry participants helps gauge the industry's profitability and potential risks. Industry lifecycle. Consider the stage of the industry's lifecycle. Industries may be in the early growth stage, mature stage, or declining stage. Each stage presents unique opportunities and challenges. Assessing the industry's lifecycle helps determine the potential for growth, innovation, and consolidation. Economic sensitivity. Analyze the industry's sensitivity to economic cycles and external factors. Some industries are more cyclical and may be impacted by economic downturns, while others are more resilient. Evaluate how macroeconomic factors, such as GDP growth, interest rates, and consumer spending, may influence the industry's performance. Key success factors. Identify the key success factors within the industry. These may include factors such as cost efficiency, product differentiation, customer service, distribution channels, or technological expertise. Understanding the factors that drive success within the industry helps assess the competitive advantage of companies operating within it. Industry trends and disruptions. Stay informed about industry trends, emerging technologies, and disruptive forces that may reshape the industry. Analyze the potential impact of these trends on existing companies and identify opportunities for innovation and investment. It's important to gather industry-specific information from various sources, including industry reports, market research, trade publications, and company filings. Additionally, consider attending industry conferences and engaging with industry experts to gain valuable insights. Consulting with a financial advisor or industry specialist can provide further guidance and expertise tailored to your investment goals and risk tolerance. 3.2 Technical analysis in short selling. Identifying bearish chart patterns and indicators can help investors anticipate potential price declines in a stock or market. Here are some common bearish chart patterns and indicators that traders and technical analysts often use. Head and shoulders. The head and shoulders pattern consists of three peaks, with the middle peak, the head, being higher than the other two, the shoulders. It suggests a potential trend reversal from bullish to bearish. Double top. A double top pattern occurs when a stock or market makes two consecutive peaks at approximately the same level, indicating resistance and a possible reversal in trend. Rising wedge. A rising wedge pattern is formed when the price consolidates between upward sloping trend lines. This pattern can signal an impending price decline. Bearish engulfing. A bearish engulfing pattern occurs when a larger bearish candle completely engulfs the previous smaller bullish candle. It suggests a potential reversal in trend. Shooting star. A shooting star candlestick pattern forms when the price opens higher, trades significantly higher during the session, but then closes near its opening price. It indicates potential selling pressure and a possible reversal. Moving average crossovers. The crossover of shorter-term moving averages, example 50-day, below longer-term moving averages, example 200-day, is considered bearish. It suggests a potential shift in momentum and downward price movement. Relative Strength Index, RSI. RSI is a momentum oscillator that measures the speed and change of price movements. An RSI reading above 70 indicates overbought conditions, potentially signaling an upcoming price decline. Moving Average Convergence Divergence, MACD. MACD is a trend-following momentum indicator that calculates the difference between two moving averages. A bearish signal is generated when the MACD line crosses below the signal line. Volume analysis. Increasing volume during price decline suggests selling pressure and supports a bearish outlook. Analyze volume patterns in conjunction with price movements to confirm potential bearish signals. Fibonacci retracement. Fibonacci retracement levels are horizontal lines that indicate potential support and resistance levels based on the Fibonacci sequence. A bearish signal is generated when the price fails to break above a key Fibonacci retracement level. It's important to note that these chart patterns and indicators are tools that provide potential signals of bearish market conditions. They should be used in conjunction with other forms of analysis, such as fundamental analysis and market research, to make well-informed investment decisions. Additionally, no indicator or pattern guarantees accurate predictions, and it's essential to consider the overall market context and manage risk appropriately. Moving averages and trend lines are popular tools used by traders and technical analysts to identify trends and make informed trading decisions. Here's how they can be utilized. Moving averages, MA, smooth out price data by calculating the average price over a specific period. They help identify trends, support/resistance levels, and potential reversal points. Here are a few ways to use moving averages. Trend identification. Plotting different moving averages on a chart, such as the 50-day, 100-day, and 200-day moving averages, can help identify the direction and strength of a trend. A rising price above the moving averages suggests an uptrend, while a declining price below the moving averages suggests a downtrend. Moving average crossovers. Moving average crossovers occur when two different moving averages cross each other. The most common crossover is the 50-day moving average crossing above or below the 200-day moving average. A bullish signal is generated when the shorter-term moving average crosses above the longer-term moving average, indicating potential upward momentum. Conversely, a bearish signal is generated when the shorter-term moving average crosses below the longer-term moving average, suggesting potential downward momentum. Support and resistance levels. Moving averages can act as dynamic support and resistance levels. In an uptrend, the moving average can act as a support level, where the price tends to find buying interest. In a downtrend, the moving average can act as a resistance level, where the price tends to face selling pressure. Trendlines. Trendlines are lines drawn on a price chart to connect swing highs or swing lows. They help visualize the direction and strength of a trend and can be used for various purposes. Trend identification. Drawing a trend line along a series of higher lows in an uptrend or lower highs in a downtrend helps identify the prevailing trend. The slope and angle of the trend line can provide insights into the strength of the trend. Support and resistance levels. Trend lines can act as support or resistance levels. In an uptrend, a trend line drawn below the price can act as a support level. In a downtrend, a trend line drawn above the price can act as a resistance level. Traders often look for price reactions around these trend lines as potential entry or exit points. Trend line breakouts. A breakout occurs when the price breaks above or below a trend line, signaling a potential change in trend or increased momentum. Traders often wait for a confirmed breakout to enter trades or add to existing positions. It's important to note that moving averages and trend lines are subjective tools, and different traders may use different periods or techniques. It's advisable to combine them with other technical indicators, such as volume analysis, oscillators, and chart patterns, to gain a more comprehensive understanding of the market and make well-informed trading decisions. Additionally, it's essential to consider other forms of analysis, such as fundamental analysis, market sentiment, and risk management, when incorporating moving averages and trend lines into a trading strategy. Timing entries and exits based on technical signals involves using various indicators, patterns, and signals to identify optimal points to enter or exit a trade. While no method guarantees success, technical analysis can provide insights into potential price movements. Here are some common techniques used to time entries and exits. Confirmation of chart patterns. Look for the confirmation of chart patterns before entering or exiting a trade. For example, if you identify a bearish head and shoulders pattern, wait for the price to break below the neckline before entering a short position. Oscillators and overbought/oversold conditions. Oscillators such as the Relative Strength Index, RSI, or stochastic oscillator can indicate overbought or oversold conditions. When an oscillator reaches extreme levels, it may signal a potential reversal in price. Look for divergence between the oscillator and price for additional confirmation. Moving average crossovers. Utilize moving average crossovers as entry or exit signals. For instance, a bullish signal may be generated when the shorter-term moving average crosses above the longer-term moving average, indicating upward momentum. Conversely, a bearish signal occurs when the shorter-term moving average crosses below the longer-term moving average. Breakouts and breakdowns. Monitor price breakouts above resistance levels or breakdowns below support levels. A breakout indicates potential upward momentum, while a breakdown suggests downward pressure. Wait for a confirmed breakout or breakdown before entering or exiting a trade. Trendline breaks. Look for trendline breaks as potential entry or exit signals. A break above a downtrend line or below an uptrend line can indicate a shift in momentum. Wait for confirmation of the breakout or breakdown before taking action. Candlestick patterns. Utilize candlestick patterns to time entries and exits. For example, a bearish engulfing pattern or shooting star candlestick may indicate a potential reversal and provide a signal to exit a long position or enter a short position. Volume analysis. Analyze volume alongside price movements to confirm signals. Higher volume during breakouts or breakdowns indicates increased market participation and may validate the signal. Low volume during a price move may suggest lack of conviction and caution. It's important to note that relying solely on technical signals may not capture all relevant market factors, and it's advisable to consider other forms of analysis, such as fundamental analysis and market sentiment, to make well-rounded trading decisions. Additionally, risk management techniques, such as setting stop-loss orders and managing position sizes, are crucial for mitigating potential losses and protecting capital. Traders often combine multiple technical signals and use them in conjunction with risk management strategies to increase the likelihood of successful entries and exits. 3.3 Event-driven short selling. Trading on news and corporate events involves taking advantage of price movements resulting from significant news releases, earnings announcements, mergers and acquisitions, product launches, regulatory decisions, and other corporate developments. Here are some considerations when trading on news and corporate events. News sources. Stay updated with reliable and timely news sources that provide information on relevant events. This can include financial news websites, news aggregators, press releases, company announcements, and regulatory filings. Event calendar. Use an event calendar to track upcoming corporate events, earnings releases, economic data releases, and other market-moving events. This helps you plan your trading strategies and be prepared for potential volatility. Impact assessment. Evaluate the potential impact of the news or event on the company, industry, and overall market. Consider the significance of the news, the company's historical reaction to similar events, and the potential implications for future earnings, market sentiment, and investor confidence. Fundamental analysis. Conduct thorough fundamental analysis to assess the company's financial health, competitive positioning, growth prospects, and valuation. Determine if the news or event aligns with the company's long-term fundamentals and growth trajectory. Technical analysis. Combine technical analysis with news-based trading. Look for technical patterns, support/resistance levels, and trend lines that can provide additional confirmation or entry/exit points in conjunction with the news or event. Volatility and liquidity. Consider the potential impact on volatility and liquidity. Major news releases and events can result in increased price volatility and wider spreads. Ensure that there is sufficient liquidity in the market to execute trades effectively without significant slippage. Timing and execution. Timing is crucial when trading on news and corporate events. Plan your trades in advance, taking into account the expected timing of the news release or event. Consider placing limit orders or using stop orders to enter or exit positions at desired price levels. Risk management. Implement effective risk management strategies to protect against adverse price movements. Set stop-loss orders to limit potential losses and consider position sizing based on your risk tolerance and the expected volatility associated with the news or event. Reaction analysis. Monitor the market's reaction to the news or event. Assess whether the market reaction aligns with your expectations and adjust your trading strategy accordingly. Consider taking profits or cutting losses if the market does not respond as anticipated. Stay disciplined, maintain discipline and avoid impulsive or emotional trading decisions. Stick to your trading plan, adhere to risk management principles, and avoid chasing exaggerated price movements or trading on rumors without proper verification. It's important to note that trading on news and corporate events can be highly volatile and carries inherent risks. Prices can react quickly and unpredictably, and it's essential to stay informed, conduct thorough analysis, and manage risk effectively. Consider consulting with a financial advisor or professional trader who specializes in event-driven trading strategies for further guidance and expertise. Shorting stocks with negative catalysts involves taking a bearish position in stocks that are expected to experience a decline in price due to specific negative events or catalysts. Here are some considerations when shorting stocks with negative catalysts. Identify negative catalysts. Research and identify specific events or catalysts that are expected to have a negative impact on the company's stock price. This can include factors such as poor earnings results, negative news releases, regulatory issues, legal problems, product failures, management changes, or industry headwinds. Fundamental analysis. Conduct thorough fundamental analysis to assess the company's financial health, competitive positioning, and overall business prospects. Evaluate factors such as revenue growth, profitability, debt levels, cash flow, and valuation. Ensure that the negative catalysts align with the company's fundamental weaknesses or risks. Technical analysis. Utilize technical analysis to identify potential entry and exit points for short positions. Look for bearish chart patterns, trendline breaks, or indicators signaling weakness in the stock's price movement. Consider using moving averages, trendlines, and oscillators to confirm the stock's downtrend and potential downside momentum. Risk assessment. Evaluate the potential risks and rewards of shorting the stock. Consider factors such as the liquidity of the stock, borrowing costs, margin requirements, and potential for short squeezes, when short sellers rush to cover their positions, causing a rapid increase in the stock's price. Assess the risk-reward ratio and ensure that the potential profits justify the risks involved. Timing and execution. Determine the optimal timing for entering the short position. Consider the expected timing of the negative catalyst and the potential impact on the stock's price. Plan your entry carefully, taking into account market conditions, liquidity, and potential price volatility. Execute the short sale through your brokerage account and ensure that you comply with any regulations and borrowing requirements. Risk management. Implement effective risk management strategies to protect against adverse price movements. Set stop-loss orders to limit potential losses if the stock's price moves against your short position. Consider position sizing based on your risk tolerance and the expected volatility associated with the negative catalyst. Monitoring and exit strategy. Continuously monitor the stock's price movement and the progress of the negative catalysts. Have a predefined exit strategy in place, considering factors such as target price levels, trailing stop-loss orders, or changes in the fundamental or technical landscape. Be prepared to exit the short position if the stock's price starts to show signs of recovery or if the negative catalysts lose their impact. Due diligence and research. Conduct thorough due diligence and research to ensure that you have a comprehensive understanding of the company, its industry, and the potential impact of the negative catalysts. Stay updated with news and developments related to the stock and regularly reassess your short thesis based on new information. Shorting stocks with negative catalysts can be a profitable trading strategy, but it also carries significant risks. Market dynamics can be unpredictable, and stocks can experience unexpected price movements. It's crucial to conduct proper research, manage risk effectively, and stay disciplined in your trading approach. Consider consulting with a financial advisor or professional trader who specializes in short-selling strategies for further guidance and expertise. Analyzing earnings reports and regulatory actions is an important aspect of fundamental analysis when evaluating companies and their potential impact on stock prices. Here are some key considerations for analyzing earnings reports and regulatory actions. Earnings reports, revenue and earnings. Focus on the company's revenue and earnings figures, as they are key indicators of its financial performance. Compare the reported numbers to analysts' expectations and the company's historical performance. Look for trends and patterns that can provide insights into the company's growth trajectory. Profit margins. Analyze the company's profit margins, including gross margin, operating margin, and net margin. Assess whether the margins are improving, stable, or declining over time. A narrowing of margins could indicate increased competition or cost pressures. Guidance. Pay attention to the company's guidance for future performance. Guidance provides insight into management's expectations and can influence investor sentiment. Assess whether the guidance is in line with market expectations and whether it aligns with the company's historical performance and industry trends. Key performance indicators, KPIs. Evaluate other relevant KPIs specific to the company's industry. This can include metrics such as same-store sales growth, customer acquisition, churn rates, or average revenue per user. Understand the industry benchmarks and compare the company's performance to its peers. balance sheet and cash flow. Analyze the company's balance sheet and cash flow statement to assess its financial health and liquidity. Look at metrics such as debt levels, cash reserves, free cash flow, and working capital. Evaluate the company's ability to meet its financial obligations and invest in future growth. Regulatory actions, compliance and legal issues. Evaluate the impact of regulatory actions or legal issues on the company's operations. Financials and reputation. Assess any fines, penalties, or regulatory changes that could affect the company's business model, profitability, or competitive positioning. Industry regulations. Understand the regulatory environment in which the company operates. Monitor any new regulations, policies, or changes that could impact the industry as a whole. Consider how these regulations may affect the company's operations, costs, or ability to generate revenue. Government policies. Assess the potential impact of government policies, trade agreements, or geopolitical events on the company's operations and markets. Consider the implications of policy changes related to taxes, tariffs, subsidies, or import-export regulations. Competitive landscape. Analyze how regulatory actions may affect the competitive landscape and the company's position within it. Consider whether regulatory changes could create new opportunities for the company or pose significant challenges to its market share or growth prospects. Investor sentiment. Evaluate how regulatory actions are perceived by investors and the broader market. Assess whether the market has priced in the impact of the regulatory actions or if there may be opportunities for mispricing or market overreaction. It's important to conduct thorough research and analysis when analyzing earnings reports and regulatory actions. Consider the overall market conditions, industry trends, and the company's specific circumstances. Combine fundamental analysis with other forms of analysis, such as technical analysis and market sentiment, to gain a comprehensive view of the company's prospects and potential impact on stock prices.